Inflation in the Eurozone has set another record high for the 7th month in a row. The latest data shows that Eurozone inflation came in at 8.1% for the month of May, which is higher than the forecasted inflation of 7.7%. This has a very real impact on consumers like you and me. Grocery shopping inflation has hit its highest level since 2013, with the latest research showing that shoppers are reducing their buying and turning to cheaper alternatives in an attempt to control cost. Rising prices have a very real impact on our standard of living, especially when we're not receiving a pay increase to match inflation. More than half of households in the UK, for example, have reported having to make adjustments to their spending in order to cope with the rising cost of living. But why is all of this happening? How long will it last? And what's being done to solve it? Those are the questions we're going to answer today. Taking a look at the Eurozone inflation data from the past 10 years, we can see that each of the lines on the graph are at high points. These lines denote the inflation of all items: food, alcohol and tobacco, energy, non-energy industrial goods and services. As can be seen, inflation across the board has been pretty flat in the Eurozone since 2012. But the most notable line is this red line, which is representative of energy prices. Energy prices includes the price of electricity, gas and fuels. During 2020, the demand for energy, in particular oil, collapsed, causing oil prices to go negative for the first time on record. There was massive uncertainty around the long-term impact that the pandemic would have on economic activity, leading to a massive oversupply of oil as worldwide demand fell rapidly. Market uncertainties impacted all energy sources during 2020. However, the price of energy in the Eurozone and indeed worldwide started to skyrocket during 2021. The primary reason for this was bottlenecks in energy supply. You see, during 2020, global household savings increased significantly, with the likes of French and German households saving 1.6 times and 1.5 times 2019's amounts respectively. This led to a lot of pent-up demand for goods and services in consumers, so that when spending restrictions were lifted, there was lots of demand for everything all at once. Naturally, this translated into a renewed surge in demand for energy. However, that demand was not met with supply. There are a multitude of reasons behind the energy supply crisis in the Eurozone, but the problems which existed in 2021 were further exacerbated in 2022 with the Russian invasion of Ukraine. The EU has now taken the decision to ban 90% of all Russian oil imports by 2023. Russia supplies 27% of the oil which is imported into the EU and 40% of the gas. So naturally, all of these factors are weighing on the inflated energy prices that we're seeing today. What'll be most interesting for consumers is the impact that this decision will have on petrol prices in the short term, though many country leaders are already warning consumers about the impending increases in energy costs. Higher energy prices are borne not only by consumers but also by businesses. We recently saw US retail giants Walmart and Target report uninspiring earnings results, with one of the reasons cited being higher energy prices that hadn't yet been passed on to customers. In a European context, you have to wonder how many retailers are holding off on increasing prices to protect consumers, and more importantly, how long that can last in the face of unwavering inflation. Food, alcohol and tobacco prices were up 7.5% in May, compared with 6.3% in April. How much higher can they go if the full brunt of rising costs are passed on to customers? Even the inflation measurements excluding food and energy prices have increased to 4.4% from 3.9%. So what's being done about it? The responsibility of ensuring that prices remain stable within the Eurozone falls on the European Central Bank. The target rate of inflation that the European Central Bank has set is 2%, which is obviously much lower than where inflation is currently at today. Now, what's important to realize is that the inflation we're seeing is the byproduct of demand outstripping supply. Central banks are only able to influence the demand side of the equation. They have no control over constraints in supply. How they influence demand demand is through what's known as conventional monetary policy, which is just a fancy way of describing the process of adjusting interest rates. By increasing interest rates, it becomes more expensive to borrow money, therefore reducing the amount of money circulating in the economy and by proxy, reducing the amount of demand for goods and services. Naturally, lower demand alleviates some of the pressure on prices and can help bring the cost of living under control. The European Central Bank is far behind where the US Federal Reserve is at in terms of increasing interest rates. The Fed has already increased rates twice this year, with further increases coming in both June and July, with many commentators backing consistent rate increases until inflation is brought under control. The ECB, on the other hand, have yet to start increasing rates. However, with Eurozone inflation setting record after record, the pressure to get started is well and truly mounting. The chief economist of the ECB, Philip Lane, has indicated that interest rates will increase by 25 basis points, or 0.25% in both July and September this year. This is much more conservative than the Federal Reserve's rate hikes of 0.5%. Granted, the US is experiencing higher rates of inflation. However, some suggest that higher rate increases from the ECB aren't off the table. Ultimately, the goal here is to get interest rates in the euro area to the neutral rate, whereby the economy is neither being stimulated nor restricted. But the fear is that interest rate hikes will be too aggressive and will ultimately send the economy into a recession. And how that works is effectively demand being lowered so much that the reduction in output within the economy falls into the recession category. The French economy has already shrunk by 0.2% from the previous quarter this year, and that's down to the pressure on prices caused primarily by the Russian invasion of Ukraine. Consumers aren't buying as much because of cost. That's happening before any interest rate hikes have been made. So how much worse will consumer buying activity get after interest rates start to increase? Bear in mind that falling economic output combined with rising prices, which is what the French are seeing, are two of the three ingredients required for the economic nightmare scenario that is stagflation, with the last ingredient being unemployment. In fact, many commentators have noted that much of the European Union is facing a period of stagflation. The other cause for concern here is a wage price spiral. Many workers are probably asking why they can't just receive a pay increase to offset some of the negative effects of inflation. After all, when inflation is rising and your pay remains the same, you have, for all intents and purposes, received a pay cut because your salary can buy you less than it could before. That's why you're seeing unions across the EU push for higher wages for workers. Historically, wages in the Eurozone have lagged behind both the US and the UK, but now it's expected that Eurozone wages will increase by 3% by the end of the year, which will be the largest increase in a decade. The problem is that increasing wages in response to inflation only serves to worsen inflation. You see, inflation is somewhat of a self-fulfilling prophecy. If businesses were to pay their workers more money because the cost of living has gone up, that would translate into higher costs for the business. What do most businesses do with rising costs? They pass them onto the customer. So the effect of rising wages is rising prices. What happens is that we get caught in this feedback loop of prices and wages increasing as a direct result of one another. So what's the bottom line? My concern is that the ECB and even the Fed will continue to increase interest rates until they see a reduction in inflation. But that reduction might not come quickly if the supply chain crisis continues to persist, which central banks ultimately have no control over. So what could happen is a reduction in output due to lower demand by consumers because of higher rates, high unemployment because businesses feel the pinch of lower revenues and earnings, and consistently higher prices because of persisting supply chain constraints. We know unemployment goes hand in hand with recessions, which is worrying when you consider that rising interest rates translates into higher mortgage payments for homeowners who can't really afford to lose their jobs. Ultimately, all of this is speculation, and we won't know how events will unfold until they happen. There is so much uncertainty around future decisions that the European Union will make with regards to Russian energy imports, which could mean much higher prices for longer time periods. Plus, the ongoing issues with the global supply chain crisis stemming from China and their zero tolerance policies is still cause for concern. We know that many European businesses have supply chain dependencies in China's key ports, and so long as those ports continue to be disrupted, so too will European business. Unfortunately, it's just one of those things where we'll have to wait and see. But let me know, what are your thoughts on the rising cost of living? Have you been feeling the pinch, and have you had to make any adjustments to your spending in order to cope? So I really do hope you enjoyed the video here today. If you did enjoy today's video, you can check out more like it by clicking either of the videos popping up on screen now. I'd really appreciate it if you showed your support by leaving a like in the video and subscribing to the channel. And I'll see you in the next one. Cheers.